Hi, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. So one thing that's really important, you want to really make sure that you're keeping up to date in what's happening financially in terms of legislation and things that are changing within the economy to make sure you're putting yourself in the best position to reach your financial goals or to retire or be financially independent or whatever you want to do. One thing that was recently proposed, which in my opinion was kind of ridiculous, is they're talking about a certain tax that's gonna be put on investment. And make sure you watch till the end of this video because I'm gonna talk about what they're proposing and the problems with what they're proposing. Around 1914, there was a small percentage tax that was put just on the wealthy. But later on, as we could see, as time went on, from 1950s to 1960s and all the way up until today, taxes have increased for everyone, not just the people that make a lot of money, at least prior to the point where people weren't paying taxes at all. And this is primarily because of poor money management, people in power not knowing to do with money and getting into the hole of spending money recklessly on debt and all these type of things that didn't necessarily pay off in the future, and it ended up costing everyday Americans a lot up until today. And because of the things like unfunded liabilities like Social Security and Medicare and all these things that are going on, the government is looking for ways to get their hands on money. And I've been talking about this a lot on my channel, is why I also talk about ways you could avoid tax, legally avoid tax. And it's going to be more and more important in the future as tax laws change, because the government is looking for ways to take money because they're not looking to spend any less. And in order for them to keep up with the project that they're trying to do, they're gonna try to find ways to get their hands on any money they could get their hands on. And one thing that has been proposed is a tax on unrealized capital gains. In the news, you may have recently heard Janet Yellen, Treasury Secretary, actually talking about things they could do to tax unrealized capital gains. And they were talking about it to be focused primarily on the ultra wealthy. But it's a very dangerous place to go into, and I'm gonna explain why. Like in 1914, what they first proposed was just a tax just a small percentage tax on the people that were at the 2% or 2% of high income earners at the time in 1914. As you can see now, this tax, the income taxes now have actually trickled down basically to everyone. Now everyone pays income tax. And like I said, it's the number one expense for most Americans, so up there with the number one expenses for most Americans. And what I have to say is, if they do propose this unrealized capital gains tax to the people that are wealthy currently, right now it's only being proposed to the top billionaires. But what would make it any different from what happened in 1914? It all starts with this. They start taxing, or they put a tax that seems like it's not going to make a big impact currently, but after people get used to that tax and all those type of things, that's when it starts to get to the entire population, where they start to increase that tax or basically broaden that tax to everyone so the government could get more money. The thing is, the government is looking to get more money from people because they're not looking to spend any less, and they really need money to cover things like the unfunded liabilities and all these type of things. So they're looking for other ways to maneuver around getting their hands on people's assets. And one way they're trying to propose is this unrealized capital gains tax. There is a variety of different types of taxes in the US. There's income tax, there's capital gains tax, there's property taxes. But in this video, I'm going to specifically focus on unrealized capital gains and realized capital gains. Now, what is unrealized capital gains? Let's say you have a stock or equity fund that grows to $200. It was originally $100. And 2 years later, it grows to $200. If you don't sell that asset, that is considered unrealized capital gains. You don't realize it until you sell it. So once you actually sell the equity and get that $100 difference that you made, that would be considered realized, and that $100 would get taxed. And that would be taxed at long-term capital gains rates because you held it for 2 years. But with, let's say, for example, this was being proposed where everyone was getting unrealized capital gains, that $100 will get taxed at the end of the year, considering that if it gets to the point where that tax is brought to everyone. The thing is, when it comes to the stock market is the most accessible wealth building tool in the world currently. The thing is, there's no barrier to entry when it comes to investing in the stock market. The thing is, when you're investing in things like real estate and other types of things, businesses, you might need a lot more money to put down. But nowadays, with stock apps and all these type of things and technology improving, people could start investing even with like $15, $20 a week, which is pretty amazing. So technology improving is kind of eliminating the barrier of entry when it comes to investing. But if you think about it, if this happens to get to the point where unrealized capital gains starts to affect people in the middle class and the upper middle class, it's going to be a lot harder to build wealth, because if you have to sell your stock at a price that you don't want to because you have to pay unrealized capital gains tax, you might just have to do it, because if you can't afford to pay the tax, just to pay the tax on that, you would have to liquidate at a time before you want to, because how else are you going to pay for it? A lot of people are living paycheck to paycheck, and if you look at the statistics of people even making $100,000 a year, people making $100,000 a year sometimes live paycheck to paycheck. It says about 40% of people currently with that type of income do live paycheck to paycheck currently. So if you think about it, let's have an example. Let's look at this year. People's homes, let's say you had a home value of say $400,000. Prices of homes went about 25% up this year. So that means you had a 25% unrealized gain on your home. Along with that, you're also gonna have to pay higher property taxes on your home. So if your home goes from $400,000 to $500,000, you're gonna have to pay property taxes on that eventually. Also, if this unrealized capital gains ends up going to the point where middle class people have to pay for it, imagine if there was even a 5% tax on unrealized capital gains. That means that $100,000 would be unrealized, and you'd have to pay 5% on that $100,000. Then that would be $5,000. And like I was telling you, people that make $100,000 in income are still living paycheck to paycheck. A lot of them, 40%. So, considering that fact, how many people just have $5,000 just lying around somewhere? Most of the time, they don't have that. So, if you think about it, this is gonna actually force people to liquidate things like the homes, their stock market assets, and a lot of things that they wouldn't otherwise liquidate, and it would eliminate their wealth building ability over time. So a lot of everyday people that are making average incomes are able to become millionaires because of investing in things like the stock market and real estate and all these type of things and letting it grow over time. But this would be this would hinder the growth a lot if you think about it, if people weren't able to grow their assets and not have to pay taxes on unrealized capital gains. And another thing that might make this problematic is it's really hard to evaluate the real value of a company. Sometimes it takes years before people could get a firm holding on what their company is actually worth. So if you think about it, if you're investing in something like a startup or a small cap company that is growing or in the process of growing, what might be on paper might not be what you could actually sell it for. So just because your stock or your equity or your company says it's $2 million on paper, it doesn't mean that anyone is actually willing to buy it from you. So the thing is, whenever it comes to, say, the stock market, there has to be a buyer and a seller. If there's no buyer willing to buy your equity or your stock at a certain price, you're not going to be able to sell it no matter what it says on paper. So at the end of the day, it's very problematic to charge people a tax where they might not even get that money to pay it. So where is the money going to come from is the next question. And if for whatever reason you can't sell your stock at that price at that tax year, or you decide to hold past that tax year and the stock ends up dropping, which is typical for a lot of startup and companies that are small cap, is that they fluctuate a lot. You're gonna have a lot of taxes to pay that you're not gonna be able to pay because of things like not actually having the real income at hand. So generally, what's taxed now is realized capital gains. So if you have a stock, that same stock at $100, it grows to $200, and you sell it 2 years later, and you sell it at that $200 amount, that realized gain is $100. You actually made that money, and now you pay taxes on just that $100, because you could actually have the money to pay for the tax. But if you don't actually sell it, you might not actually have the money, because a lot of people don't just have money sitting down in a mattress somewhere to just pay taxes. I consider this very similar to a wealth tax, which I also think is a very bad idea, for the reason being that money that's not actually in your hand shouldn't be taxed at all. It doesn't really make sense, because if you don't actually have the money to pay for a certain tax, a lot of people might be forced to liquidate their assets, and that might affect things like growing businesses and all these type of things, and it's going to affect businesses and small cap companies from growing, because a lot of these companies, they need to reinvest capital and all these type of things into their business to let it grow to that point where it's a solid organization and it's consistently making income. Right now, the tax is only being proposed on the top 1,000 about Americans, basically the ultra wealthy billionaires. But even with that, the tax is only going to give about $200 billion in the next 10 years. And if you look at the US debt and things that have been happening with the economy, like we had stimulus of over $2 trillion, and the spending bills and all these things that have been passed have been over $2 trillion. Is it going to last at all? But in reality, it isn't going to solve much. When it comes to taxes, it always starts with the top. They start putting in a little bit of tax at the top. And the thing is, once a law is established already and a tax legislation is established already, it's much easier to expand it over time. So it might not be a 1, 2, or 3 year thing, but over time, as people get more comfortable with the tax and get used to paying it, they're not gonna mind, or they're not gonna question it much when it starts to trickle down to lower incomes and everyday people start paying that tax. And then the government is going to be starting to go for things like retirement funds and mutual funds, brokerage accounts, and all these type of things, along with raising taxes in the future, which is highly likely, in order to get more money to fund their cash leaking operations. In my opinion, I think this proposal is kind of troubling. I don't see it working, and hopefully it doesn't get passed, because it doesn't really make a lot of sense. Let me know what you guys think. Leave a comment below and let me know what you guys think. And in my channel, I constantly talk about things about personal finance and investing and all this type of things. If you found some value in this video, go ahead and like, comment, subscribe. I talk about a lot of different strategies you could do to avoid things like this, so you can put yourself in a position where you don't have to worry about tax proposals and stuff like that. So if you're interested in learning more about that, watch my other videos, or feel free to leave a comment below to ask me a question. Or feel free to email me or contact me through my website in the description below.